Hi, Alasdair. Look, it's great to see you again. And before I start this question, Darryl and I have got two questions, and usually we have five, but we think there's going to be a lot of input into this, so we'll see how we go. But I'm going to say to the audience that these two questions are based on the last two Substack stories that Alasdair has produced this week. Two stories this week. Now, I can't overestimate the value of Alice's Substack channels, right? So these are two questions that I've come from, that I've seen. I've brought it through. I would recommend everybody that's listening to sign up to Alasdair's Substack and try and don't just stick with the free one. Buy for $150 Australian. You can get everything that Alasdair's writing. It is really good stuff to listen to and to look at. All right, Alasdair, in your latest Substack dated September the 9th, the headline read, Debt Funding, Inflation and Gold. There were some vital points. You mentioned good and bad debt, President Trump and his trade tariffs, America already in recession, massive inflation coming, and last of all, the American debt trap. Could you walk through these points to our viewers today?
Yes, indeed. The funding position is getting out of control. That is basically Bessant's problem, Bessant being the Treasury Secretary. You've got a combination of things happening here. On the one hand, you've got Trump's big, beautiful bill, which is adding to the overall debt pile. On top of that, there are increasing signs that the US economy actually stagnating and probably in recession. I would refer in particular to the recent unemployment numbers or employment numbers, which have been very disappointing as far as Trump is concerned. He sacked the head of the BLS a few weeks back, and he's now ranting and raving about the most recent releases, which was an enormous downgrade of previous numbers by something like 900,000 jobs. And at the same time, he is attacking the Federal Reserve and particularly Jay Powell. There is this situation where I think that the US Treasury is beginning to understand that they have got a funding problem. The slowing of the economy is very, very damaging to government finances because it means that there's less tax revenue coming in. I mean, this is not an immediate effect, but this will materialize, particularly in 2026. And also welfare costs will be increasing. So this adds to the debt burden, if you like. And at the same time, you have, if you like, evidence of a buyer's strike in the longer maturities. In other words, investors are beginning to take the view that the growth in the level of debt in the US is becoming unsustainable, and they require higher compensation for the risk of investing in long-term debt. Now, this contrasts hugely with the problems of a recession. I mean, the Keynesians look at recession and say, well, what recession means is that consumer demand falls and therefore prices fall. We need to have prices rising in order to encourage consumers to continue to buy. This is a load of rubbish because it all based on the idea that production continues as before and is not affected, if you like, by the change in consumer behavior. This doesn't happen. What happens is that production also declines because guess who is behind the production? The consumers who work in order to produce. So this is actually the reality of the situation. And what it means is that we can have a recession. In fact, with every deep recession, this is automatically true. We have a recession and we find that prices are rising at the same time. The big instance where this didn't happen was when the dollar was on a gold standard in the 1930s. And that basically prices were maintained in gold above what they would have been, if you like, if it was just a pure fiat currency. And this was why Roosevelt devalued the dollar against gold by 40% in early 1934. So the problem now faced by the Fed and the US Treasury is becoming intractable. This is a real problem. I think that the debt aspect of it is extremely important. At the same time as debt is becoming unsustainable, of course, the Fed is under enormous pressure to reduce interest rates. We have a situation where the markets expect an interest rate cut this month in September, in a few days' time, next week. And at the same time, they expect further cuts later on in the year. Now, that completely ignores the inflation outlook, because the inflation outlook is determined by the purchasing power of the dollar. At the same time as the Fed is cutting interest rates, which tends to reduce the attractiveness of the dollar, particularly to investors who are already concerned about the rising risk of too much debt. At the same time, you have President Trump calling for a lower dollar, along with Stephen Mirren, who is just getting appointed. He was the man behind the so-called Mar-a-Lago Accord, and he's just being appointed to the Fed. And my guess is that he would be Trump's nomination for the next Fed chairman. So looking at it from outside, you can see the dollar's going down. The dollar's going down because of growing political influence from President Trump and his fellow executives. This is not a good situation at all. Now, if you look at what happens in this case, the first thing we can see is that the trade-weighted index is in a bear market. And technically, it looks terrible. And you can easily project a further 10 to 15% fall in the value of the dollar measured against the other major currencies, principally the euro and to a lesser extent the Japanese yen. So that's one problem. The other problem is that we see that the gold price is rising, which more accurately described is actually not the gold price rising, though there's probably an element of it, but the dollar falling, or more importantly, perhaps an expectation that the dollar will continue to fall. So we have this situation where it's already difficult for America to fund itself. And at the same time, it's trying to cut the interest cost on the government, which basically will put off buyers even more. And we're not just talking about foreign buyers who own some $40 trillion of currency and underlying financial investments, including deposits, but we're also talking about the investing institutions, and particularly the major ones. And investing institutions such as pension funds, insurance companies, and so on and so forth, who would normally automatically be buying treasury debt. They will be going on strike. That is the prospect, because they will look at this, and particularly at this time of year. September is the time when committee meetings occur in these big institutions, these investing institutions, when they plan for their investment policy in the last years of 2025, and perhaps looking into the first quarter of 2026. They will be bearish on treasury debt. Now, there is also the implication here, which is a further concern, and that is that if you look at the equity market, that is wildly overvalued relative to the yields on long-term debt. Now, I have been producing a chart for some months now, which clearly illustrates that the level of the disparity in the valuation between equities and the long bond is over twice as high as it's ever been in the past. This is a risk for a collapse in the equity market when the long bond yield starts rising again. Now, the thing to watch is when it begins to approach the 5% level. At the moment it's about 4.8, 4.9, something like that. But if it goes through 5% yield, then this is going to ring huge alarm bells in equities. And if you look at the equity market itself, we have, obviously, if you like, a debt come credit bubble. And a lot of the credit expansion has been aimed recently at investing in assets. So that the expansion of bank credit has been to finance margin debt for people who think that equities are going up forever. And the last figures that we've had from FINRA indicate that this margin debt is in excess of $1 trillion now. In other words, it's increased fivefold in the last 10 years.
Jeez.
So when that happens, you can see, yes, this is a bubble in equities. I mean, it's quite simple. People are buying momentum because they think things are going up forever rather than value. And for those of us with in this game with a little bit of memory will remember this was exactly the situation in the dot-com bubble in the years 1998 to 2000. And if you go further than that and you read of historical bubbles, such as the South Sea bubble and so on, it's exactly the same thing. This is, if you like, a very human condition propelled by greed rather than fear. And this is something which is important. It's exactly the same situation that we had in 1929. And between 1929 and 1932, the S&P, the Dow, lost roughly 90% of its value. Another thing propelling the equity market downwards at that stage was the Smoot-Hawley Tariff Act. And guess what we've got today? We've got President Trump's wonderful tariffs, which are all part of his Make America Great Again, but is basically destroying trade, international trade. It is dismantling very, very efficient supply chains, for example. The consequences of this have yet really to be fully understood, or indeed to be reflected in markets. But I would say that the combination of a wildly overvalued equity market and trade tariffs waiting to be tripped up by rising bond yields is going to be catastrophic. It's going to be catastrophic for the financial sector. And what it will mean is that equities held as collateral, of which we can see at least $1 trillion just in margin debt, and that doesn't include equities which are held as general collateral against other loans, say property loans, mortgages, businesses, whatever. That will get sold down. It'll get sold down because banks need to secure the value of the loans at a time of collapsing collateral value. So that will add to the downward element. On top of that, foreign investment in US equities is in the region of $15.5 to $16 trillion. That is enormous. Now, why are the foreigners there? They're there for speculative reasons. It's as simple as that. They may dress it up and say, well, we're diversifying into other markets. Yeah, fine. But when the chips are down, it's speculation, let's face it. So there are huge forces in the financial sector waiting to be unleashed when the long bond yield goes up above 5%. And at the moment, nobody recognizes this. Another factor, of course, is that when you get this rise in bond yields, this is going to trip up the whole of the corporate debt scene. And all those debt zombies who loved the situation back in 2020 when interest rates were zero, or in the case of the Eurozone and also Japan, negative, they're going to be refinancing that debt because, you take it out, sort of, let's say it's a five-year loan, 5 years, 2020, 2025, whoops, we're going to have to pay an awful lot more. Are they sustainable? No, you're going to get massive corporate failures. The problem here is that the Fed and the US Treasury have set themselves up not just to be the lender of last resort, but the supporter of the whole system in the case of a systemic crisis. or a financial crisis. The only way in which this can be salvaged is by the production of money printing, credit printing, replace the contraction of credit in the banking system with an expansion of credit by official sources. What's that do to the dollar? Pushes it down even further. Yeah. So coming back to the current situation where everybody expects falling interest rates, this is a trap, because the consequences of a collapsing dollar will be what they call higher inflation. In other words, prices will rise and rise and rise, not because nasty capitalists are trying to protect their margins, but because the purchasing power of the currency which you use to buy these products is collapsing. So what we are likely to see is far, far higher rates of inflation in 2026 and into 2027 than anyone dreams possible today. And it's all part of, if you stand back from it and you look at the bigger picture, we got into fiat currencies in 1971. That was the way forward. This was the new world. Well, this is the end of the fiat currency system. We can see it rapidly approaching, and it's going to be interesting and very unpleasant.
There are 3,800 fiat currencies. Which ones are surviving? None.
Zero.
And that's what Darryl and I have learned, that fiat currencies, there is not one out of 3,800 or more have survived. The only currency to survive is called money, and that is gold and silver.
So what would make anyone think that the dollar was going to stand up for the first time in 5,000 years?
Yeah.
Hardly.
Hardly at all.
It is. I've got to say, it is interesting that governments really don't learn from previous errors. They keep on making the same mistakes. You would think they would learn.
Short-term thinkers. Fiat currency might work in the first 20 years, but the rest of the time, it just builds up that debt until it just collapses. Yeah.
Hi, Alasdair. This morning you wrote again on your Substack channel with a headline, "The Dollar Calm Before the Storm." This article is so important for people to understand that we are heading for a financial hurricane, as Jamie Dimon, head of JP Morgan, has already confirmed. In your article, you took us back to 1920, 1923 in Weimar Germany. And so if you could continue the story in regard to how the US dollar will be impacted and what will be the downside if you don't own gold and silver.
Yes, the purpose of that article was really to find a historical comparison with what's happening today. And of course, the most famous and most documented hyperinflationary collapse was the Reichsmark following the First World War, and when it finally collapsed in 1923. The collapse was very, very dramatic, and it's always been something which is, if you like, in the German psyche. We don't want to go there again. It's used as an if you like, as an example of appalling government behaviour and the willful destruction of the currency by the government. No, interestingly, what happened in Germany in general, if we just look over that whole period, we had politicians trying to deal with a very difficult situation. And they were, in that sense, they were driven by politics rather than economics. There were in the government various people who actually had a reasonable understanding of the difference between money and credit, gold and the Reichsmark, and they were silenced. They couldn't, if you like, pursue the sensible policy from an economic point of view because the politics wouldn't allow it. That is the same situation we have today. So that is the background. Interestingly, the Reichsmark lost something like 80% of its value between 1918 and 1920. Now, following that period, there was a period of stability. And it was an extraordinary period of stability. The fall in the Reichsmark encouraged, if you like, production and exports. It also encouraged tourism, believe it or not, after the First World War. You had wealthy visitors coming in from places like America and all the rest of it. A lot of Americans were descended from Germans, so you could see that there was this influx, if you like, of stability. Now, we're not talking about what actually happened to the rate of expansion of credit, but businesses began to hum a bit and all the rest of it. And between particularly February 1920 and the end of 1921, the stock market soared. It tripled. And this meant that, people with a bit of wealth, as it were, after the war, what was left, recovered their positions substantially. And there's this feeling of, wealth and things were good and it was all going well. But then in December, 1st of December 2020, the stock market began to collapse. Now, it lost 25% of its value in December that year. But then things started going downhill. And we found that from that time onwards, the purchasing power of the Reichsmark began its downward trend in earnest. And by most of the collapse was actually in the last 6 months of 1923. Sorry, I'm a century out, 1923. And that was when we had the reports of people collecting their wages in cash and then taking them around in a wheelbarrow to go and buy a loaf of bread and all this sort of stuff. The sad thing about this was that it meant the complete collapse, if you like, of wealth. It meant the impoverishment of the professional classes. The labouring classes weren't impoverished, but everybody was on the breadline, and food was getting very hard to come by. People living in the cities weren't getting supplies from the country because they couldn't pay for food supplies from the country. So farmers, farming communities, and all the rest of it were very reluctant to send food into the cities. So the situation was really very, very dire. But the interesting thing in the way this worked was there were three phases. You had the initial 1918 to 20 phase. You had the 1920 to end of 21 phase. And then you had the final collapse. This actually looks quite like the situation we have today. We had COVID in 2020. We had the fall in the purchasing power of currencies, in other words, unexpected inflation, which peaked 2 years later in 2022. So, since then, inflation has declined and is no longer a problem. And we have the stock market that's absolutely soared. I mean, the S&P has gained, 50, 60% or something in that time?
That's correct.
Not as dramatic as the German stock market between 1920 and the end of 21, but nonetheless, pretty dramatic. And like in Germany, that period was characterized by increasing speculation and the feeling that things were going up forever. And what have we got today? We've got increasing speculation, feeling that everything's going up forever. And that speculation is going even further. I mean, we created new media to speculate in, things like Bitcoin. Okay, we can create a nice little story behind it, and everybody's buying into it. But guess what? They're making loads and loads of money. This is exactly like what happened in Germany in the middle of this crisis. Yeah, that middle step, if you like, the sort of the stabilization bit in the middle. That's where we are today. But this raises the thought, from 2026, are we going to be like Germany in 1922, going into 1923? Now, here we've got to look at the politics of the situation. Can we possibly imagine the political class who are currently completely driven by political considerations, breaking with what happened in Germany, where they continue to be driven by political considerations into the ultimate currency collapse. Can we see our politicians getting off that track? Can we see them having a mandate to actually create massive unemployment, to let the economy basically sort itself out, stand back, and say, we get involved in the economy, we just mess it up. We're going to stand back. We're going to go back onto a gold standard. We're going to stabilize the currency. What? Do we really see that? Politicians are not elected to do that. I would love to be convinced that someone, somewhere, will step in and have the authority to do it before the ultimate collapse of today's fiat currencies and prevent them continuing on the course which the Reichsmark followed until November 2023. As a matter of interest, 2023, the ultimate collapse, then something could be done about it. But it had to collapse first. Crisis first, solution always second. And the solution was to value the Reichsmark at $1 trillion to 1 gold mark. They didn't introduce the gold mark. The whole thing was a con trick, but it worked because everybody wanted it to work. And if you put it in terms of dollars, before the First World War, when both the dollar and the mark were on the gold standard, you had 1 mark was worth 23 US cents. What this meant was at the final reckoning in November 1923, you had $1 being the equivalent of over 4 trillion Reichsmark. That was the extent of the collapse. Now, please, someone tell me how we get off this roller coaster. That third stage is what we have ahead. And just to, the escape route is obvious. But of course, nobody's taking it yet because everybody believes that interest rates are coming down, inflation is not a problem. It's exactly where they were in November 1921. That's where we are emotionally. It's exactly the same. But the escape route was get into hard gold-backed currencies. But there are no gold-backed currencies at the moment. Now, I suspect that China and Russia will go on to, they will back their currencies. But can we buy those? No, we can't. It's not available to us. I suppose you could do something on the black market, but do you really want to do that? No. The answer is to buy gold, which throughout history and in everybody's common law is real money, with everything else being credit. Everything else being credit. And just to, if you like, sort of put a little bit of a final anecdote on this, by late 1923, you could buy a large house in Berlin, in a nice, swanky part of Berlin. And remember that between 1920 and 1921, all the wealth that had accumulated meant that property prices and all the rest of it in fashionable areas were through the roof, just as they are apartments in Manhattan or Mar-a-Lago in Florida or whatever. All these things were incredibly valuable. Well, you could buy one of those for $100, which at the time was roughly 5 ounces of gold. That's where it sank to in late 1923.
Wow. I did hear that in 1923 that income generators, the working person, was being paid twice a day just to be able to keep up with being able to afford to purchase something in the evening. If they only got paid in the morning, the dollar, their currency had devalued that much, they had to be paid again to cope with the afternoon.
The inflation.
Yeah,
man.
unbelievable.
Yeah. I'd just like to add a point, and I know I've brought this up once before, but people don't underestimate the numbers that Alasdair is talking about. And could it happen again? Oh, yes, it could. And I'll just give you some basic numbers here. I'm going to convert the currency into seconds, right? So in 1 year, we have 31.5 million seconds. If you want to look at a billion seconds, you have to go back 28 years, 1997. If you want to look at a trillion seconds, you have to actually go back to 30,000 years before Christ was born. That's a trillion seconds. Now, America has got $37 trillion in deficit. That's the government, 37 trillion. This is not figures out of the air that Alasdair is talking about. This is real stuff, and it's going to happen. So, yeah, 6 ounces of gold to buy your house. I mean, what a wonderful position to be in if you've actually owned physical gold and silver. Yeah. And all this information, guys, comes out of Alasdair's Substack channel. I don't underestimate it. Go on to Alasdair's Substack. Pay $150 to get the full stories, and you'll never look back financially.
Oh, I agree. You learn so much.
Absolutely.
It's all about the people who read the books you read. And you've got an opportunity here to take advantage of Alasdair's knowledge on this subject, a subject that will determine whether or not you generate wealth during these very, very difficult times, take you through to another level. I mean, it's such an important topic. And you're looking at somebody at the moment, Alasdair, that's as good as anyone in the industry when it comes to an understanding of how this monetary system works and will play out. So I couldn't agree more. Get involved, right, in Substack. And I mean, it's such a small investment for the amount of knowledge that you're going to be generating out of it now. Alasdair, if we can remember going back 1971 through to 1980, silver was a huge performer. In 1971, it was valued at around $1.20 an ounce. And in 1980, it had escalated to a point where it was sitting around $50. It was up over that period of time, over 9 years, well over 3,000%. So I've never heard Egon von Greyerz talk as enthusiastically about silver as he is right now. He is a gold man. He's built his whole life around gold. And has the biggest private vaulting service in the world. I mean, he's an icon in this industry. And he would normally just talk about silver. Get some silver. Silver's fine. But the main emphasis has always been gold. It still is. However, he is right now saying this, if you're going to buy silver, buy it now. This is the time. Could you comment on that and just give us your impressions as to where you think silver's going? And yeah, exactly that, if you could, thank you.
Yes, I agree with Egon. I mean, the background to silver is that in Europe, it was a monetary metal until about 1870. And what happened was, in the wake of the Franco-Prussian War, Germany or Prussia managed to extract war reparations from France in the form of gold. At that stage, Prussia and associated German states went off. Silver standard went on to a gold standard, and other European nations on a silver standard did exactly the same thing. So that was the thing. It's also worth remembering that it wasn't until, I think it was about 1968, that China came off a silver standard. So it was on a silver standard
right
well into the last century. So it is associated as a monetary metal. Now, if you look at history, monetary metals actually do tend to evolve. If we go back to the first evidence of a monetary metal in Roman law, we go back to the time of the 12 tables, which was 448 BC. And the currency then, which really grew out of the 12 tables, was called the AES, AES in modern spelling. Now, that was £1 of sort of copper bronze coin, as it were. And ice was £1. And that's where we get today. It's sterling £1. It was in our case, it was a pound of silver. So that was the origin of it. Gold came in later. Gold has always had the sort of the precious value associated with it because it's incorruptible. I mean, there's no point going over all that sort of stuff. You can read about it elsewhere. But it emerged, if you like, under Roman law as the favored form of money. Now, the difference between money and credit was actually defined in the wake of the 12 Tables by various jurors, particularly in the 1st and 2nd century AD. The jurors confirmed were Gaius. You also had Ulpian and Paulus, the 3 jurors who were really instrumental in defining the difference between money and credit. Money was always final settlement. In other words, when debts are discharged completely, you have paid for it in money, and that has cancelled all debts. Everything else is credit. Now, the banking system evolved out of Roman law, and the banking system evolved on the basis of credit. What is a bank? It's a dealer in credit. I think that's an important point to understand. So as things evolved, if you like, then we had the introduction of silver standards. In the case of Britain, under William the Conqueror, we had silver standard, sterling silver standard, where a pound was a pound of silver. It got changed, if you like, debased through time. I mean, Henry VIII was one who debased it, etc. You had other problems like coin clipping and so on and so forth. And we finally came off a silver standard and went on to a gold standard, really unofficially, I would say, in the late 18th century. But by the beginning of the 19th century, we'd really evolved onto a gold standard marked by the newly produced sovereign, which first came out in about 1817. The gold standard was formally applied in the early 1820s, and that ran through all the way to the First World War. The interesting thing is that credit expanded and contracted under the British gold standard, but you could always change a Bank of England banknote for gold coin. And even to this day, the legal requirement on a Bank of England note is for the bank to promise that exchange. No, the exchange is suspended. But the point about silver was that part of the arrangements whereby we went on to a gold standard is that silver remained legal tender for an amount up to £2 or 40 shillings, as it was described. Now, if you look at the sovereign today, the sovereign is worth roughly £650. So that shows what's happened to the paper pound, if you like, to sterling. So if we went back onto that sort of relationship between gold and silver, you would see silver circulating for amounts of under £1,300, which is quite a significant figure today. I mean, £1,300 is, you can buy quite a lot with £1,300. It'll keep you in groceries for half a year, actually. So see that, if you like, is a relationship. No. It's a reasonable supposition to suggest that if we get a collapse in paper currencies, fiat currencies, and gold then becomes, again, as under Roman law, which it still is, if you like, the basis of the whole monetary system, then there is going to be that role for silver. Silver will be a secondary monetary metal to gold. No doubt about it. I mean, think today, if we've got one sovereign, which is somewhere between a quarter and a third of an ounce of gold. I mean, it's not a big coin. That's worth £650. You're not going to be able to go into a into a store and say, I want to use this to pay for my groceries or whatever.
Yeah.
But you will use silver.
Yeah.
You see that this relationship actually is still important. We're a long way from this actually happening in terms of travel, if you like. Now, in terms of time, I don't know. I mean, it could happen quite quickly. But you can see that silver still retains this important role. Now, if we come back to current markets, in the days when we had a silver standard or a bimetallic standard, the relationship between gold and silver was roughly 15 or 16 ounces of silver to 1 of gold. Today, we're looking at a ratio of 80 ounces of silver, 88 ounces of silver to 1 of gold. So this is very, very far from the situation where fiat currency effectively collapses and we have to have a new, if you like, means of exchange. So this is, if you like, the attraction of silver in the markets. As we see the increasing risk of the failure of the fiat currency system, of the two metals which are going to accelerate most to reflect this, obviously it is silver. So this is where Egon is right. And if you look at the charts, I mean, you can see the momentum under the silver price at the moment has been really spectacular. So we're talking about a metal which is not really in very, very great supply. And bear also in mind that because this is, if you like, the poor man's gold, if we can sort of use that slightly pejorative phrase, then the demand for it is likely to be very, very substantial as the general public wakes up to the situation. So we could rapidly see that gold-silver ratio, the number of silver ounces to gold, falling from the current 88, 87, down to below 50, down below 30, and in an ultimate collapse, maybe even below 20. So it makes a lot of sense to have some silver. It really does. But the principal sheet anchor to value is always going to be gold. So that's your top. But if you really want to catch up with what's happening, silver will help you do that.
Yeah. Well, I know in 1980, 1,000 ounces of silver bought a median property. Sounds ridiculous, but a median property was $50,000 in the US, and an ounce of silver was $50. 1,000 times 50, 50,000. It bought you freehold a median property.
Bring me those days back.
So who knows? I mean, and Alasdair's talking, 20 to 1 ratio, 30 to 1 ratio. I think it closed into 15, Alasdair, in 1980, 15 to 1 ratio. So it's still hopelessly undervalued at the moment, so it's got a long way to go and potentially could do that. Yeah. Very exciting times there for silver.
For gold and silver, and owning those two metals.
Alasdair, we learned so much from every single one of these interviews. I really appreciate the time and the effort, the energy you spend with us as an advisor to this company. How can other people benefit? We've mentioned Substack, of course. Can you just quickly confirm with our viewing audience what they could expect to receive with Substack? How do they get involved? What's the process?
Yes, well, thank you for the opportunity, Darryl. Basically, Substack is MacleodFinance.com. That will take you to it. Or alternatively, AlasdairMacleod.substack.com. It's probably MacleodFinance.com is probably your easiest route. I write at least twice a week. And one article will be about economics or geopolitics, if you like, that broader picture. And I tend not to sort of focus on minutiae. I'm just trying to get over the broad situation, if you like. And then on Fridays, I write what could be loosely termed a market report. It's a market-related report, what is actually going on in the markets, and looking at some of the factors that are likely to drive markets in the following weeks. And the other thing I do is that if I see anything really relevant, for example, this interview will be broadcast to my wider network, not just the paid subscribers, but also the free subscribers. And also if I see other things which I think are relevant to people protecting their wealth. So this is a time of wealth protection, not wealth accumulation. And that's an important message to get over. Then I publish those as well. So generally, but the paid bit is really for my Friday market analysis, and also at least once a week a broader economic or geopolitical analysis, or whatever I think is really relevant at that particular time. And the articles which you referred to in this interview were basically for my paid subscribers. And so they will also already be aware of this. And I think that, as you say, when it comes to getting real information, it does make sense to pay for it. If you don't have to pay for it, then you're being marketed. So that's that is the emphasis I think you've got to understand. I have no other interest. I'm not dealing in gold or anything like that. I'm just trying to tell it as it is. Yeah. And I hope that's the value that I impart to subscribers.
Excellent. Yep. Thank you so much for that, Alasdair. And I can only suggest very strongly that our whole viewing audience should take advantage of Alasdair's offer. We've benefited massively in the process. Alasdair, thank you once again. Really appreciate the time, the effort, the energy you spend supporting As Good as Gold Australia. And we'd also like to thank our viewers and subscribers for the support that they give to this channel. And so until next time, all stay well, stay focused, and goodbye for now.
Goodbye for now.